Good morning, everyone. How we doing today? Happy to see you all. If you're live, tuning in, drop a comment. Let me know that you're here. Ready to get started. Hello, my friend Minor Ramos is in the house. Trusted Covenant. Hello, hello, hello. All right. Let me see. Why is my thing not updating here? There we go. Now I can see. All right, 13 people's in the house. Cool. Cool beans. All right. Today's going to be intense. Just letting you know, giving you a heads up. The title, I don't know if gave it away. A lot of topics that I want to be able to cover. So I'd like to go in order. Hold me accountable. If I start steering off, if I'm going off on a tangent, reel me back in. All right, I'm asking for support on that. But we're going to be talking about the velocity banking concept, just some updates industry-wide, what's going on in the marketplace. Got some cool things. We're going to talk about credit cards. All right, a lot of you are struggling with the credit cards. A lot of you are having trouble fully maximizing the usage of credit cards. And then I think there's a little bit of misrepresentation going on as it relates to credit cards. And it's also case by case, right? Just because we hear one thing on one video being said, that doesn't mean that's gospel and we go run with it. It may not apply to everyone in the room. So I want to give you templates as to, generally speaking, this is the format, the goal we should be looking to accomplish with credit cards. And then I want to give you some parameters that if you go outside of bounds, right, and you start entering risk, I want you to at least know, okay, if I do this move, this is adding more risk. This is adding more leverage to what I'm already doing, right? Not to say that that won't work. I just want you to know there's additional risk here if you move forward. Could you get a fantastic result? Maybe. But it can also backfire and set you back on your goals, whether it's your debt-free goal, investment goal, whatever it may be, cash flow goal, your offset goal. I want you to be aware of those things. Then we're going to touch on the Money Max account. That's been getting a lot of attention lately, and I think it's due to the rise of velocity banking content creators putting out more material, and people who disagree with velocity banking are giving it even more attention, right? Because they're putting out videos that are like, this is why velocity banking doesn't work. And then you have the velocity banking gurus that are like, this is why it does work. Here's a case study. Here's a review. Here are the numbers. And then back and forth, but it's getting so much attention. And I think it's actually for the better. And I think what's happening is people who have been doing things a certain way with their finances has worked, let's just say, for a period of time. But due to the last 4 years, inflation, taxes going up, cost of living rising extremely fast, and not keeping up with cost of living. So let's just say you're someone that was debt-free. Let's say you're someone that's debt-free and you make $6,000 a month and you're cash flowing $1,500 and you're saving and you're investing, you're doing all the right things. And then in the last 4 years, let's say you live in Florida, your auto insurance went up 57+%. So you were paying $500 a month. Now you're at $850, right? Now you're at $950. Now you're at over $1,000 in car insurance, okay? Then your FPL bill has been increasing over the years. And let's say your has gone up $700, $600, right? And food and gas, that's gone up 30%. So in the span of just 3-4 years, your entire cash flow gap, talking to someone who's debt-free right now, like those of you listening and catching the recording, this is an example. You know who you are. You're like, I've been doing the 7 baby steps with Dave Ramsey. I've been saving, contributing. I'm doing all the right things. And I'm seeing my cash flow shrink, 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 and shrink, and shrink. happening really fast. So you went from a $1,500 cash flow to $1,000 to a $750 to a $500 to a $250 to now you're like basically paycheck to paycheck, even though you've been getting, say, promotions or steadily increases, and it just hasn't been keeping up. And then an emergency happens. Someone gets COVID in the family. Someone passes away. Okay, now we have to deal with this. Okay, unexpected expense. Oh, the roof has to get repaired. Oh, this happened. And so now life is happening. Your income is not keeping up with your standard costs. I'm talking to people who are just living modest, right? And you don't have a fancy car, a fancy house. I'm literally talking to people who are debt free. So you own your car, you own your home, right? And you were making decent money, you had decent cash flow, but it got totally wiped out in the last couple of years. And now you're like going back into debt. Where velocity banking comes in is it really creates a healthy gap, provides liquidity, and teaches you how to be an effective borrower so you basically pay nothing in interest. So there's scenarios where you pay zero, you offset your borrowing costs, or you just are in a better term of debt environment, right? And so many people are starting to discover this channel and other people's channels like Connor J. Wallace and Christy Van. Honestly, those are the three most active velocity banking content creators: Connor J. Wallace, myself, and Christy Van. And then there's a few smaller channels that are picking up steam. So shout out to them. I think Ask Me How I Budget is one. And there's like one or two other people. I don't remember their names. And then you do have Matthew Pillmore. But he doesn't touch too much on velocity banking. He's more of a real estate guy, investing and create more income. So we're seeing the content really blow up, right? So velocity banking, I want to take the next 10-15 minutes or so. If you have a burning question right now, there's like 31 people plus watching right now. If you're new to velocity banking, or you're getting it going, you're getting results, or maybe you're struggling, you are trying to figure out whether I should go with this debt tool or this debt tool, or I should go with this bank or that bank. Got any specific questions right now as it pertains to the velocity banking concept strategy itself? Now's the time to ask your question, and I want to address it. While I'm waiting for those questions to come in, I'm going to merge the topic of Money Max account, right? Because I do have some notes on here already regarding the company and the product. Company name, United Financial Freedom. Product, Money Max account. Money Max account has been a software tool. You can call it a budget tracker. It's a debt elimination software. A very helpful tool to hold you accountable, to be able to see all your numbers visually, and it'll run different scenarios of how you can go about your personal finances. It's very customized, okay? It's a higher ticket item, so it can cost anywhere from $3,500 to $5,000, maybe a little more than $5,000, depending on how much debt and how many mortgages you have. And I want to say, if we look at history, right, the author, founder of velocity banking is this guy right here, Harsh Gill, right? So he brought it to the masses. United Financial Freedom Money Max account, I think, established in the early 2000s. I could be wrong. I think they got established in the early 2000s. They went through a couple name changes, right? This is typical in the multi-level marketing, network marketing space. Is the company starts off with a certain name, they get sued, they change their name, they get sued again, they change their name. Eventually they figure things out, they get a little bit better. And so for the last, I want to say, decade, United Financial Freedom has been called United Financial Freedom. Before it was Worth Unlimited, and then they had another name. So they went through some challenges, some obstacles, but they were a company that was trying to take the velocity banking concept, put it in a software, right? And they were, running and gunning with the HELOC strategy, first lien, second lien, all through the 2000s. Then 07, 08 hits, and they basically shut down, right? Like all of their clients, a lot of their clients' HELOCs got frozen, canceled. They weren't able to do the strategy properly, and you can imagine a lot of unhappy people, right? Well, then they revamped the company, probably changed their name in that time, and then they launched the checking savings sweep strategy of eliminating debt. So to be clear, that's not velocity banking. I think there's a lot of misrepresentation going on some videos that I've been watching, unfortunately, people that I know. And I'm like, um, there's a difference between the two. If you're going to use the Money Max account, which is a software, and I'll share my screen, just kind of let you take a look at it. It is predominantly starting out, even when you get a demo, right, from someone that's trying to sell you the software, it's just doing checking and savings, meaning you make income, it lands in your checking, it has you sweep certain dollar amounts from each paycheck into savings, and then it strategically tells you on the perfect day when to make a payment extra toward a specific debt that would get you out of debt in the fastest time possible. So it's basically incorporating the snowball strategy, avalanche, cash flow index. All three of those are, running this AI algorithm, whatever tools they're using on the back end, these formulas that they put in to help the client pay off their debt as quickly as possible without a line of credit. Because as I said, 07, 08, the company kind of got crushed because they were only preaching using a HELOC or a line of credit to eliminate debt. And then when people couldn't get lines of credits and it was really hard to come by and banks were failing, they had to pivot. So then they launched this out. And so for the last, decade or so, it's kind of been that way. Now, there is an element of velocity banking in the Money Max account software. I want to be very, very clear about that. It can be done, but it's not automatic. It's not like you're just going to buy the software and then it's going to tell you how to do velocity banking. And unfortunately, that's how it's being sold right now, where there's a lot of people thinking that they're buying the software. They heard me talk about it. They heard Christy Van. They heard Connor J. Wallace or someone else on YouTube talking about velocity banking, running the numbers on the whiteboard, that sort of, style that we all do. And they buy the software, they get in, and they're lost. They're trying to get their numbers in there, and they're like, so how do I, do velocity? How do, what, oh, so it's just the checking and so now it's telling me that the checking and savings is faster than velocity banking. And so that's where the confusion occurs. And there's people live here right now that have been quoted the Money Max, or maybe you even have it. And many of you are actually booking calls with me because you're like, Denzel, I bought this software for $3,500. I bought this software for $5,000 for $4,000. And, I've had it for a month, or I've had it for 2 months, and I'm putting the numbers in, but I feel like something's wrong. It's not telling me to use my line of credit or my HELOC. And I'm a little confused. And so over here, I'm running a clinic kind of helping people with their financial strategy to incorporate velocity banking. They had the initial intention of wanting to do velocity banking, and they kind of was missold, misrepresented. So what I want to do is help clear the air, draw distinctions, help you understand if the product is actually right for you or not, right? Help you move forward, and letting you know, full transparency, I've been a part of the company since like I've sold the Money Max account multiple times. I partnered up with my friend Sebastian Boyer, business credit expert. He did most of the selling to my clients that wanted this Money Max account software. It has value. Let me not devalue the product. What I'm saying is it's being misrepresented in the marketplace. People are thinking that they're just going to jump in and do velocity banking. And I'm here to tell you that it's not automatically going to tell you how to do it. You actually have to train the system to do it for you. So that implies that you need to know some prior knowledge on how the concept works so that you can input it into the system. And then the system is going to help you track your progress that much more efficiently. Okay? Super, super important that I draw that distinction. Okay? So I saw some questions come in, right? Hello, Diane. David said, it's what's happened to me now. My wife can't work due to some medical issues, living paycheck to paycheck. Yes, like people that were doing okay, like the Davids, right? And they were cash flowing and they were told to never use debt, avoid debt. And so you just wasn't taught, and you were, encouraged to stay away from debt, not realizing how effective and efficient leveraging debt can actually be for you, right? So now Dave is on this channel, right? And I hope I can serve you. I hope I can point you in the right direction. There's only so much David can do to lower his lifestyle, right? You can only shrink so much. Does that make sense? Like you can't shrink your way to wealth. You can't save your way to wealth. Not in today's America. Maybe prior to 1971. But until now, you live in a debt-based society. Money isn't worth anything. It's fiat currency. It's not backed by anything. There's over $6+ trillion that have been printed in the last couple of years. The game has changed, and it's been changed since 1971. We have to understand this. Debt can actually be a tool. Debt can be a resource to make money, create cash flow, and have tax-free access to liquidity, right? Very, very important. Nate says, how much does the Money Max account actually cost? So Nate, it's a range, right? So if, let's say Nate does not have a mortgage, you're going to have the cheapest price of the Money Max account. And then let's say Nate obtains a mortgage after purchasing the Money Max account, you would have to upgrade your account in order to add your mortgage into the system. Okay, so it's purely based off of how many mortgages you have and the amount of debt that you have, right? If you are military, you do get a discount of $500 off the product, right? So it could be as little as around $3,500, I think. Could be wrong. I bought the Money Max account years ago for around $1,500, right? And I had a discount for getting in, and I'm in the company, right? So I'm actually someone that sells the product and I own it. A lot of people on the internet that may be promoting Money Max account, I don't want to assume here, but I do know based on how they're speaking, they don't actually own the software. So they're just promoting it. Like, oh my God, look what this does. But they haven't actually done it themselves. And so again, misrepresentation. They don't know what they don't know because you haven't taken the time to actually go to the software and put your own numbers in and run multiple case studies. I have. I've been doing this, right? So I paid about $1,500 way back then, Nate. That was like 2021. I know it's gone up over the years. And so the typical range is anywhere between $3,500 and as high as like $5,000 or maybe a little bit more than $5,000. Edwin says he got quoted $3,900. Cool. Good morning. Wow, that's a lot. Yes, Nate. Totally get it. John says PLOC or HELOC for velocity banking. So John, if you have a home with equity built inside of it, it is going to be more advantageous from a cost perspective for you to get a home equity line of credit. Almost every time, if we do our homework, if we do the pregame work, velocity banking pregame work, and find the right bank, you will always find a home equity line of credit at a cheaper interest rate than your personal line of credit. Personal line of credits typically are always higher on the interest rate then your home equity line of credit. In addition, with a HELOC, you're typically going to find, when you do it the right way, the way I teach it, you'll find an intro rate offer the first 6 to 12 months. So you get a nice boost, and then the rate changes. And in some cases, we can also find fixed rate HELOCs for 3 to 5 years, right? So that creates a steady understanding of what your interest costs will be for the next 3 to 5 years, right? So if, John, you do not own a home, a personal line of credit is your next best option. If you're a business owner, a business line of credit is going to be your next best option. If you don't own a home, you rent or you live with family, whatever the case, whatever the situation is. The PLOCs, if you do your homework properly, you can find a personal line of credit right now in today's marketplace under 10%, right? The typical range, the lowest ranges that I've been seeing is anywhere between like 7.5 to just under 10%. Most personal line of credits are above 10% right now, 2024, right? Where the way rates are, okay? Nate says, is it worth it? Okay, let's dive into that. Take it to the whiteboard, right? So this is my analysis after working with so many people for so many years as it relates to the Money Max account, whether it's worth it for you or not. Okay, here's what I have seen. Anyone that's tech savvy, okay, I think this is important. If you are tech savvy, good with spreadsheets, you're going to be accountable, right, by yourself, okay? Accuracy, and in addition, the Money Max account has a subscription on top of buying the product, right? There's a subscription, I think it's like $15 a month, and it connects all your accounts. In my opinion, especially if you're brand new, it's absolutely worth having that subscription so that it'll automatically transfer all your expenses, all your incomes. It'll lay everything out instantly. So that increases efficiency, that increases speed. If you do it manually, here's the thing. If you do it manually, you need accuracy. You need to be accountable. You need to be tech savvy. Now, there is a team that helps you, put these numbers together. They have a support team, and there's some coaching for a period of time. Someone can correct me. I believe the coaching is only 6 months long, and they kind of help you, get things, ramped up and get going. But if your timeline is 7 years to get out of debt, 8 years to get out of debt, there's not much support after those 6 months. It's just support from the perspective of the software itself, but that's not real coaching. Does that make sense? Coaching is actually having an accountability partner, process decisions, process questions, talk about different things, overcome money obstacles, challenges. No software is going to help you do that. So the human element does disappear after a period of time. So again, if you're independent, financially sound, you have discipline coming in to the software, you have the tech savvy, you're accurate when it comes to your numbers, and you have that subscription, right? Then I think it's worth it. Okay. Here's who I've been seeing people buy the product and then they're not getting the full value from it. Okay. This is because I have history now. I can see things in hindsight. So I'm like, okay, yeah. So basically, for my baby boomers, typically, my seniors that did not grow up with a cell phone in your hand, that did not grow up with all this technology, I have seen them struggle the most as it relates to the Money Max account. Where I've seen my seniors, my baby boomers do the best, It's right here. I literally have some of my clients buy a whiteboard in their own home. They hang it up on the wall, or it's pen and paper, or it's coaching one-to-one, and it's visual, and they get phenomenal results, and they create automation in their own personal finances. Maybe they have their own personal Excel spreadsheet, some kind of tracker, and they do better than the software. They get a headache. They just struggle with comprehending it, and that's the reality of it. It's not for everyone, right? So I'm not going to be the guy that just says that this money max account is for everyone. It's going to help you become free and create all this success in your life, when I have personally worked with a lot of people who buy it and they end up not using it, right? After so many years. Like, again, we're talking 7 years to get out of debt, 5 years, 6 years. That is a long time. Accountability is needed, right, throughout the whole way. So again, it's best for those who are self-sufficient, okay? So Edwin, do you know how the Renatus velocity banking works? Okay, so Edwin, Renatus is a real estate education company, and they have a course on velocity banking, and essentially it's the same thing generally speaking, right? That's the cool part about velocity banking is, generally speaking, we're all talking about the same thing. We're either using credit cards, personal line of credit, business line of credit, home equity line of credit, first or second position. That's our template, right? So that is the general understanding there. Let me go ahead and erase this part so I can help you understand the landscape, right? So Edwin, we've got credit cards, we've got PLOCs, we've got BLOCs, and we've got HELOCs. These are all the products that the bank has to offer as it relates to a revolving line of credit. Then there are add-ons or bonuses as it relates to velocity banking. Bonus is you've got something called a secured line of credit, right? You've got margin line of credit, right? But see, below this implies that you have something to back up to get this product, right? With credit cards, PLOCs, BLOCs, and HELOCs, from right here is all unsecured debt, and then the HELOC is secured by the equity in your home, right? Over here, it's based on how much capital you already have from another location. Margin from an investment account, secured, cash value, collateral loan, whole life insurance, right? That's your landscape. So what Renata says, what I say, what the Kwok brothers say, what Kana J. Wallace says, what Christy Van says, what Matthew Pillmore says, we're all saying the same thing. We have our own little customization as to what we focus more of our time with, and that's basically based on who we're targeting, right? Who we're looking to talk to. That's where the marketing and the targeting and the niching comes in, but that's the general landscape, right? Okay. Murillo, hi, I'm wondering if using the second lien HELOC to fund an IBC policy, cash flow is $1,000 per month, but currently using the $1K to pay down the balance on the HELOC. In my opinion, Murillo, I would prefer we get your cash flow to $1,500 or more per month, and let's experience getting the HELOC to zero before we implement the IBC strategy. On top of that, based on how much money you're looking to save into a whole life insurance contract, I would prefer you to have first year's funding amount in savings. So let's say that number for you is $10,000. I would prefer you to have 10 grand in savings, not necessarily in the HELOC, right? I would prefer you to have at least first year's funding set, 10K. And then if we want to leverage the HELOC in the preceding years to help you get more of that money in, maybe you're short on cash, maybe you have $5,000 at the moment, whatever the case may be, and then get the money in there, right? I like to see as little risk as possible when it comes to leveraging debt to fund a policy, to then borrow from the policy, to then go do a move, an investment, or throw it back into your HELOC, right? It's a very attractive thing that gets talked about a lot. Even I myself have done case studies where I show how it makes sense. But I also always encourage people, like, on top of running your own numbers, let's get counsel, let's get coaching on top of this, because there is a scenario where this doesn't work, right? Where we end up over leveraging ourselves, right? Putting ourselves in a tough predicament. And quite often, there's not a whole lot of people talking about the parameters, right? And that's what I touch on more than anything in my case studies. I give you guys parameters, right? So let me give you some parameters, right? And you know this, many of you who've been here, this is going to be a refresher. Here are my parameters. I take Murillo's cash flow times 12 in a year. What is that number? And it has to be conservative. What is Murillo's conservative cash flow times 12, right? Monthly cash flow times 12 in a year, conservative. What's that number? Then I look at Murillo's HELOC and I do credit limit. What is his credit limit? And I times that by 66%, or 2/3, 66, 67, right? What I call leverage capacity. What is my capacity to leverage debt at scale without overpaying on interest or putting me in a backward momentum motion, right? Like, if Murillo has $100,000 HELOC and he takes 50 grand out and throws it into an IBC policy, can he realistically do that over and over and over again without increasing his income? How many years will it take before he is fully maxed out on this and he's fully maxed out on loans on his whole life and he's wondering, what the hell did I just do to my finances? And this is where a lot of people are messing themselves up dangerously. So let's use Murillo's numbers. Let's say he does have a 100K HELOC, right? So 66% would be 66,000. And his cash flow is $1,000 a month. So he's cash flowing 12,000 a year conservatively. Here's his chunk range. That range is too far, right? So you don't stop here. We also look at, what are we trying to accomplish, right? So another parameter is, what is the goal? So if the goal is IBC, he wants to start a policy, I do the same parameters. I take cash flow times 12 times 66% of cash flow. And I say, look, without leveraging debt, you could save $7,920 a year. Is that safe, right? If Murillo is cash flowing $12,000 a year, you times that by 2/3 to come up with how much you're going to save per year in a policy. Is it safe to say that he could save $7,920? I would argue yes, that's a very safe number, right? So now he has cash flow still left over, and whatever that cash flow went to, let's say it went to investing, saving money, paying off debt, whatever it is, that's separate, and he's saving $7,920. So we've got the first principle down: save money, tax-free, compounded, guaranteed in a safe, secure, liquid location, whole life insurance, and he didn't have to borrow. Now, let's say we want to add some leverage in here, right? And he wants to fund a little more into his policy. We could, let's say I would first want to have the HELOC at a zero balance. I know I shouldn't chunk more than 66,000, right, into the policy. It's too far of a gap. But what we could estimate is I look at Murillo's debts and I say, okay, Murillo, if you were debt free, we would free up $1,500 in cash flow. So I look at Murillo's specific situation. I look at how much cash flow would we have if you were in a debt-free position. So that, let's just say it's $1,500. So $1,500 plus the $1,000, we would have $2,500 total cash flow. Times 12, right? And then times 66%. 30K times 66%, what's that, 19,000? So that's our safe number. So this is our leverage capacity at which I would instruct, advise, work with Murillo one-to-one after evaluating all the numbers, and I say, look, we have a HELOC for 100, you're cash flowing 1,000. If we were debt-free, so we're looking out into the future, IBC is a long-term play, we could set up a policy where we're funding what we know we can do. We know we can do this number even without the HELOC. And our goal number is 19,800. It shouldn't be more than that, because if you leverage more than that in your HELOC, you're going to incur more interest charges in here, and it's going to hurt you. It's going to take you longer to bring the line of credit to zero by the time next year's funding comes around, right? And then if you don't have the funding to fund your policy, you slow down the performance of the policy. And that's where people mess themselves up. On top of that, you were taking loans, right? And eventually, boom, thing blows up. But if we can properly project by using a template, right? You don't have to be exact, but like, look at this template. It couldn't be cleaner, in my opinion. So it's like no more than 19.8. So we can set the MEC of his whole life to be 19,800. But we're only funding 7,920, which would mean the base premium is going to be much lower than 7,920, right? We can set the base premium much smaller, more efficiently, so that our minimum number is maybe somewhere around $2,000 to $3,000, right? So it's like I'm only required to actually come out of pocket 2 to 3. I'm saving 7,920, and eventually, when I'm fully debt free, I'll be able to get up to 19.8. Now, if I wanted to get ahead of the game, I could leverage this HELOC, borrow 19.8, fully fund the policy, borrow out the difference between 19.8 and 7,920. What's the difference? 19.8 minus 7,920 is 11,880. Look at his cash flow. Tell me that's not clean. Is that not like leverage capacity? So then if he borrows out 11,880 and the goal is to pay off debt, leveraging the policy over the HELOC, so he used the bank's money to fund his policy to then borrow out to pay off his debt. It's going to take longer. We know this. But he's establishing an asset in the process of getting out of debt, right? And when it comes to leverage capacity, he's only leveraging 12 months of future cash flow. That's my personal max. Leverage, max, 12 months, future cash flow. 11,880 is below conservative cash flow times 12 in a year. So he is leveraging 12 months of future cash flow to accelerate debt in the first month of, say, starting that policy. And we're technically only leveraging the difference between 12 and 19.8. 19.8 minus 12,000. So we're leveraging $7,800 on top of cash flow times 12 in a year to fully fund a policy at $19,000, $19,800 a year. He takes the same money, he borrows it out, and his focus is getting out of debt. But he's like, I also want to build this asset, right? And then when we look at the math between borrowing $11,880, we dump $19,800 in there, so there's still some savings still left in there, built in for emergencies. So he borrows out the $11,880. We're paying down debt. As debt starts to come on, and this is only one time a year. He's only doing one chunk a year. And then he owes $19,800 on the HELOC. His strategy moving forward is velocity banking on the HELOC. We're trying to get the HELOC as close to zero as humanly possible before what? The anniversary date next year. And even if we don't get it to zero, there's a $100,000 credit limit in there, and the chunk ranges between 12 and 66K. I'm never really ever going to get anywhere near 66, but I might get in the mid 20s, maybe 30s, right? And ideally, Murillo needs to have a mindset of growth. I also want to help him increase his income. Let's get you in a position where we make more money via your skills, gifts, and talents. Okay? Good stuff, Murillo? I help you out there? I just like throw you down a spiral and you're like, what the hell just happened? It's okay. This is being recorded, so you watch it back again. Okay? Back to Nate. I have 2 mortgages, a car, and a couple of credit cards. I think doing the math like you do on the whiteboard is a better idea. Okay, look, again, Nate, if you're like me, I'm a very resourceful kind of a guy, okay? If I can DIY it myself, I mean, how many people, comment below, if you're a DIY kind of a person, you'll watch a YouTube video, you go do it yourself. Let me know if that's you, if you're a DIY. I can tell you, in my life, I'm primarily DIY first. I try to see how much can I do for free? How much can I get done on my own, right? Until I make a distinction, an analysis, and I say, Denzel, that's not your field, that's not your space. Who can we hire? Because if I delegate this, I'll be able to make more money by paying someone to do this. I'll make more money over here, right? So, and the other thing is, as it relates to just finance, the topic of money, personal finance, if you're someone that has been dedicating the last couple of years, the last couple of months to transform your personal finances, and you're studying money and you're studying debt and how these tools work and how interest works and how you offset interest, understand that if you spend enough time on my YouTube channel, I'm giving you the formulas that Money Max Account is using, right? There's no magic, right? A man put software calculations into this product. So it started with men, right? Men came together and said, hey, we want to do something great for America. We want to help people pay off their debt. It's a noble mission. I love it. Cool. What are those calculations they're using? On my YouTube channel, I'm giving you the calculations. I'm just here. It's for you. You can use it, right? You don't have to pay me $1. You don't have to pay anyone thousands of dollars for anything. Until you're like, you know what? I want to bring in additional support because I value coaching. I value technology. I value resources to help expedite this process. Then I would say, yes, let's go. Let's move forward. Let me coach you one-to-one. Yeah, let's buy the software. I sell the software. Sure, let's do it. Come work with me, right? And let's have a ball, right? So if that's more like you, Nate, you're like, I think I can do this, right? And then I'm giving you the formulas, right? And then you move forward. Okay, so Judy says, I see that Money Max account has a velocity button if you want to use that strategy. Does that help it make it a true velocity strategy? I would agree, yes, right? So it's been a while since I've gone into the Money Max account, and I wanted to actually host like a Zoom meeting where we all, whoever owns the Money Max account, I want to invite you in here. And if you're like, hey, I've been doing check and savings method, but I want to get velocity going in here, right? I'd like to actually like run it with you guys, share the screen, and then see how it tells us to operate, right? So that's something that I definitely want to be able to do, because that's how I want to be able to bring more value to the Money Max community, to United Financial Freedom as a whole, right? Nate says, I need help finding a HELOC. Nate, tell me what state you're in. Tell me, what banks do you bank with currently? And I can literally do the research right now, okay, help you out and point you in the right direction. And then I'll also give you additional videos. I have a playlist that's titled All About the Line of Credit. If you watch those videos, I literally give you the full blueprint on how to find the right HELOC. I had a video drop like a couple days ago titled How to Find the Right HELOC, and I gave you guys like the template, okay? How can you compare lenders to see who is offering best HELOCs without having them pull a hard credit? Because I called one credit union, they told me they need to pull my credit first. Okay, so then we just don't do business with them, Betty, right? We don't have to understand that there's hundreds of banks that we can work with. So whenever I have to pull teeth to get information from a bank, I'm simply going to look in another direction, right? That is not true. What we can do, Betty, is we can call that bank again, and you can ask them, hey, is there someone I can talk to in the HELOC department, in the line of credit department? Who is the person that kind of operates that area? And then when you ask that question again, what are your rates for HELOCs or personal line of credit? They'll give you a range, right? And then if you get them talking using the strategies and the systems that I tell you guys to do in my videos, where I break it all down, right? I say, how do we build a relationship first with that bank? How do we pull the right information from these people? Sometimes it is displayed on the website. You just kind of have to dig for it, and I'll do it right here live with you. And then we're also trying to get information on how to qualify, right? So once they give us those details, then we can say, okay, based on this, right? So Betty said, okay, if I had 720 or higher credit score, if I had DTI of this, if I met all your qualifications, 2 years tax return, all this stuff, what is the typical HELOC rate range you're seeing right now in the marketplace? They're going to give you an answer, right? So sometimes we're just talking to the wrong people at the bank, right? And sometimes you're talking to someone that doesn't actually know what they're saying. Think of how many people, they talk to in a day. So maybe Betty, you're talking to someone that really didn't want to answer your question. And they're like, yeah, you just got to, apply first. And it's like, whoa, where's the customer service, right? Nate says it's all so confusing. Dude, I get it. So the Money Max account, here's where another advantage comes in, is when you plug all your numbers in effectively, efficiently, and accurately, you kind of don't have to think, just follow, right? So if you're kind of that person as well, if you lean more that way, you're like, hey, just tell me what to do. I really don't care. I'm not trying to be a math guru. I'm not trying to learn the formulas. I'm going to trust in this software that is going to tell me what to do. I'm telling you the Money Max account is for you, right? And I can help you provide that product for you, right? Just reach out directly if that's more. How can I get you to do the case study of my numbers? I do coaching one-to-one, so let me do one-to-one phone calls, right? I do that. You join my program. I help you one-to-one, do case studies, throw it on the whiteboard, make it happen. That is how I work, and I'll go ahead and drop my calendar link so we can start there, doing a case study. Boom. All right, it's there. So now, let me keep going here. Did I just guess? Cool. 100K balance on HELOC with another 100K available currently using cash flow to pay down HELOC. Thank you. Okay, cool. Tracy Ford, my bank offered me a loan. My husband and my credit score was over 730. When I turned the offer down, they only offered us a $3,500 line of credit. I used my Capital One 0% to pay off a bad loan. I really need to reach out to you. Yes, absolutely, guys. I'm here. I'm available. I'm not going anywhere. Like, I've been doing this the last 6 years. I plan on doing this for the next 40 plus years. I'm going to just stay in my lane and keep doing this, serving you guys. And things are gonna be even more exciting. I got some things I'm planning on announcing as well. So stay tuned. If you take out the loan on an IBC policy, at what time those loans should be paid back, or should they not be paid back? They absolutely should be paid back, right? And until, in this example, right, until Murillo increases his income to the point where we wean ourselves off of the HELOC, right? So I would be working with Murillo to get his cash flow to $19,800 a year or more so that we don't have to use the HELOC. I want to get him off. I want to wean him off the HELOC, right? This is another thing that I don't think a lot of velocity banking teachers discuss on is I'm the type that says, hey, I don't think you should be doing velocity banking forever, right? Like that's our in the game entry level strategy of leveraging debt. But by no means should we stay there forever. There are better options out there in the marketplace, such as the infinite banking concept. I would argue when you combine the two together on a long-term basis, it's even better in my opinion. And you can borrow at better rates, better costs. So being able to go from higher HELOC rates and PLOC rates to then getting into the bonus area, cash value collateral line of credit, leveraging via loans in your policy is going to cost you less in the long run. So back to your question on taking out the loan, that would be step one. He took the loan out. You know, we funded it, took the loan out. He did something with it. He's now getting charged an interest rate, let's say 5% on his $11,880. Next year, when he goes to fund his policy, right, we're always trying to get that $7,920 number. The goal is to get to $19,800. In the second year, we may not do $19,800, right? We might just do $7,920 plus whatever interest he owes on $11,880, right? $11,880 times 5%. So he'd owe $594 in interest on top of the $7,920. That's how much he would need to pay back to the loan of his policy, preferably. So I would want you to try to max fund policy, pay interest every year so that the interest in the policy doesn't compound. Don't let the interest get paid by the dividends in the policy, right? And then we leave loan outstanding. In this example, we could say until Murillo is debt-free. Let's say that in that example. So that might be, say, 5 years maybe 7 years, we're taking out a loan every year of say 11,880, whatever the case may be, right? We're leveraging the HELOC anywhere between 7,920 and 19,800, right? And we're pulling money out, and at some point we're gonna stop borrowing once he's eliminated so much debt or close to being debt free, and he's got his income higher. Then we start to pay back the loan, but every year we're always paying the interest, right? Hopefully that's helpful. Again, coaching, one-to-one, counseling, strategy. If you take the time, you work with me one-to-one, I think the amount of time I could save you, the amount of stress I could save you, the amount of headaches I could save you, the amount of money I could save you, right? I think is ultimately going to put you in a much better financial position, okay? Much better. Let's see what other questions we got coming in. Scott's like, I'm definitely DIY. DIY first, and once I realize I'm over my head, I'll look for help. I don't, I'm like you, but I don't wait till I'm over my head. I'm like, oh yeah, no, this ain't gonna work for me. Is the Money Max account a network marketing MLM product? Yes and no. So like, for example, Aldrin, you could just buy the Money Max account product. You don't have to join the company. That's how most MLM companies work. Let me give you guys let me paint this for you visually. So again, company is United Financial Freedom. United Financial Freedom is a network marketing, direct sales, multi-level marketing company. They have a corporate team, employees, staff. That's who you talk to typically on the product itself. In order for you to come across this product, they have a sales team. So the person that sells you the product may not be your financial coach, right? They're just selling you on the software. That's their job. Sell the software, sell the software, sell the software. Then on top of that, they may try to recruit you, right? When you recruit people to sell what you sell, you have the opportunity to make more money in the company. So that's what makes it network marketing, direct sales, multi-level marketing company. If you don't like this, right, you don't have to be a part of it to own the product, right? You might get hit up a couple times. They might try to sell you. They might try to get you to, hey, you want to create financial freedom for folks, and it's real easy, simple step, it's the same language over and over again in the network marketing space. I've got a love-hate relationship with multi-level marketers. I've been in that world for quite some time. I've always just enjoyed products that come out of multi-level marketing companies. The products tend to be really good. The problem is they're always trying to recruit me. I'm like, dude, leave me alone. Like, I'm just trying to use this product to change my life, right? Or improve my life somehow. So if you can get past that, a person that's just trying to recruit you, you let them know, hey, I'm not trying to get recruited, just show me how the product works, boom, they'll leave you alone, right? But yes, that is the structure. That's how this thing works, right? That salesperson makes money every time they sell the product, but they can make more money if they recruit people who also sell the product, and then they get a commission of those products that got sold. And then what can tend to happen is the vision can get sidetracked from what I've seen personally, right? So let's just say the vision of the company, is help people become debt-free. Let's say that's the vision. Well, in order to cast that vision, they've got to sell it to these people who are going to go out and sell it. So they say, hey, the software can help you become debt-free. And when we're recruiting desperate people who are trying to make money instead of help people, right? What can happen is we say things on the internet that is a misrepresentation of the product. That's the truth, right? So what happens is we try to oversell the Money Max account. We try to hype it up. We try to say things like, hey, if I can help you become debt-free in 8 years, this software will do it in 2 years faster on average, and I can guarantee that. And I'm like, that's dangerous words. You don't want to say that. You can get sued, right? So that's where the selling versus service can get a little gray, right? And then what the company did a couple years back, right? They're always about helping people get debt-free in the fastest amount of time, And then they introduce buying an IUL policy and using that to get out of debt, and it increases your debt-free timeline. So I'm like, you guys are going away from your vision. I don't know if that'll help you long-term. So now you have to teach a sales team how to sell one product, software, which many of them takes a while to even understand and comprehend it, right? And then you want them to understand IUL. IUL is a whole nother ballgame as it relates to eliminating debt. And honestly, the IUL product is, in my opinion, not a safe, guaranteed way to get out of debt. The whole thing behind United Financial Freedom and the software was they give you a guaranteed debt-free date. They guarantee that. And then you're going to push this that doesn't have guarantees that could, mess things up. So again, when you get past all of that and you're just looking for the product itself and you're like, hey, leave me alone, I'm not trying to get sold into any of your down lines or up lines, and just, help me out, then I think the product can be quite valuable, right? Diane, did I miss you explaining credit cards? If so, no worries. You did not. Thank you for holding me accountable. Let's go back to credit cards. So many of you are struggling with credit cards. So let me give you the landscape of credit cards. This is intense. I hope you guys are okay. All right, let me know if you guys are okay. I'm dropping a lot, but trust me, this video will get chopped up into multiple videos. So it's a little bit easier to, watch the replays of certain topics. So let's go through credit cards as it relates to velocity banking, right? You've got, in general, we've got credit cards from credit unions, credit cards from big banks. So let's talk about the big banks ones. So at big banks, as it relates to credit cards, you will typically find 0% intro offer, 12 to 24 months, anywhere from 3 to 5% balance transfer fees. Okay? You can also find a feature called convenience checks, which turns credit into cash. When you do a balance transfer, typically you're telling the credit company where to transfer that money W-2, it doesn't actually go into your checking account. But when you do a convenience check, it goes into your checking account, into cash, and then you get to do whatever you want with it. And you get to benefit from the 0% offer. That is typically the case. And we must read thoroughly and ask questions before we apply for that credit card to make sure we can actually do these things. Okay? Very, very important. Now, in addition to these big banks, it's also 0% on purchases as well for that same time frame. Okay? I like, personally, as it relates to velocity banking, using these cards to run bills. This is typically my primary use of these big bank cards because they typically give longer intro rate 0% periods, right? And so I'll use the card to run bills. I switch monthly to annual. I'm big on that. So I'm saving money on the bill by switching from monthly to annual. I park it in here so I don't have to worry about it for the next 12 to 24 months. And then I get cash back rewards or points, right? So cash back rewards or points. And I convert points, cash back rewards to reduce the balance of the bills that I ran on the card itself, right? Or I use it to offset a cost. You know, if points get me more than money, then typically I will do that. This is my general use of big bank credit cards. This is your Bank of America, Chase, Wells Fargo, Citi, Discover, Capital One, right? Those are the commonly known, most marketable cards out there in the marketplace, right? In addition, so that's the general use of how I guide most of my clients to use these kinds of credit cards. It's how I typically guide them. Now, let me give you some additional options out there that people will do with these cards. What I've seen done in the marketplace and what I see others talk about as well. So now you have company that will convert credit to cover cash bills, like a car, a mortgage, right? Payment. Anybody know that company? I actually literally forgot the name. Maybe y'all can help me. Put it in the comments. I did forget the name. It's coming to me. Help me out here. It's a company that will allow you to use your credit card for a fee to pay a bill that you typically would not be able to run on that card, right? Because then it would be a cash advance and that costs way more, right? So I typically take the stance of never use cash advance. There is a better way to go about doing a cash advance. That is my stance. There might be some velocity banking people that don't do that. That ain't me, because I'm always looking to be resourceful, right? So I never use cash advance. There you go. Thank you so much. How do you pronounce it? Is it plastic or plastique, right? If you want to be extra. So this company, thank you, Paige, will allow you to pay your car payment, pay your mortgage using pretty much any credit card, and then they have a fee, right? And it's much less than your cash advance fee, and because you're using your card to pay that car payment or mortgage, it's treating it like a purchase on the card. So if it treats it like a purchase, well, you don't have to pay a balance transfer fee. You don't have to pay cash advance fees. You don't pay instant interest on that credit card. You basically are able to float that expense on that card for a period of time. So this might be a pretty good strategy if we're in a bind. Maybe you're negative cash flow and you do have some space in your card, and we're just looking to, instead of borrow at a high cost to cover other bills and debts, sometimes a credit card could be that small gap, that small space. So that is something that can be used, right? That's a separate option there. Let me give you another one that's been getting popular lately that I'm not a big fan of. Let's say you have a credit card, right? And you're using the card to run your bills, but then you come across one of my fellow velocity banking content creators, and they talk about turning minimum payments to cash flow, right? I'm not too much of a fan about this. This is a bit misleading, okay? So here's the scoop. Let's say you have a $10,000 credit card. You owe $7,000. Let's say the minimum payment is 2% of the balance. It's $140 is the minimum payment. Let's say that's the case. Okay. And let's say you are in a zero cash flow situation. You have zero cash flow. And you have another bill. Let's say your internet bill is $140. Internet. What they'll tell you is, technically, what are your total expenses right here in a month? $280, right? Well, what you could do is the same $140 that you have in your checking account to pay the internet bill, instead of going more and more into debt, you take the $140 and you park it in the credit card and you pay the $140 minimum payment, preferably before due date, so you pay less interest, right? And then you use the credit card to pay the internet bill for $140, right? And that kept you from going further into a negative cash flow. And then you could stack this and maybe do it multiple times. Here's the problem. You owe money on the card. So you're still getting charged that high interest rate, 21, 29%, whatever it is. So just understand, you did not technically create cash flow, you bought time. So that's technically what's happening here. You bought time. Again, I like to be very distinct when it comes to how I market this concept, this strategy, when I talk to folks, having people understand what is actually happening here, okay? Is this strategy does have its place, does have its use, but I don't want you to get confused. It can be a little confusing, right? Because you have to get the timing right with this. You're using a bill, your internet bill, let's say, to pay your credit card bill, which satisfies the credit card bill, and then you're turning around and using the same $140 to pay your expense, right? But the problem is you still owe money. So this doesn't solve your problem. The initial problem the person has, they're zero cash flow, negative cash flow. So we have to get this up as quickly as possible and find out what we can potentially remove in expenses to put them in a better cash flow position, okay? So that is majority of case use with big bank cards, right, that I help clients with one-to-one on, right? Now, what I also do, almost no one talks about this, right? They really don't talk about this. Stepping away from the big banks, let's go to these smaller credit unions. They typically have 0% intro offers, 6 months to 12 months max, usually what I see. Here's the big benefit here. 0% balance transfer fee. 0% balance transfer fee. 0% on purchases. So here's what I do with these smaller banks, the credit unions, as it relates to their credit cards in conjunction with a big bank card. So I will typically use my credit to get one of these first. And I'm trying to get as much credit limit as I can with these small credit union credit cards. Let's say you have $1,000 in cash flow. You have a car payment of $700. You owe $35K left, right? Maybe it was higher balance, but you got it down to $35K. It's a $700 payment. You have $1,000 cash flow. When that's paid off, you'll have $1,700 in cash flow. Let's say we go to one of these credit unions. Let's say we're dealing with a husband and a wife. Let's say both husband and wife go to the credit union and they both apply for a 0% credit card and they each get $7,000. Right? And on top of that, husband has a big bank credit card, 0% for 21 months with Wells Fargo. Okay? So husband got a Wells Fargo 0% credit card and they gave him $15,000. Okay. Let's say this is the only debt that they have. Just this car they're trying to get rid of. They've been doing well, doing all this stuff, doing fantastic. Okay. Cool. What I have clients do, so I'll actually have them leverage 100% of this 0% credit card because it literally costs me nothing. There is no cost to turn credit into cash with these credit union cards, 0% balance transfer, and in many cases you can deposit the transfer into cash into your bank account. So now they have $14,000 cash that cost them nothing. And let's say they make a principal only payment of $14,000, so it brings the balance down to $21,000. Okay. Right? And then 1% of the balance, so $70. So they'll have a $70 payment. Right? So they saved a massive amount of interest on the car. They moved 14 grand out of interest into zero interest. And it now costs them a monthly payment of $140. So now their cash flow goes down a little bit, right? Because the car is not paid off yet. So 1,000 minus 140. Now we're at 860 cash flow. So cash flow went down. Okay. Now, with the Wells Fargo credit card, $15K, let's say that he has husband and wife, they've got $9,000 worth of expenses in a year that they park in Wells Fargo. So at zero cost, they park $9,000 worth of expenses. This could be a car insurance bill, a phone bill, an internet bill. This could be a subscriptions, right? I would have them target bills that if they paid it up in full for the year, it would save them money on the bill itself. And because they're running it through the card, let's say they're getting 2% cashback rewards. So on $9,000 times 2%, so they'll get $180. And let's say a statement credit of $200 if they spend $3,000 or more within the first 90 days. So we've got, say, about $380 in cash, right? That could simply be used to reduce the $9,000 expense, let's just say. So now they ran $9,000 worth of bills, right? Divide that by 12. They just created $750 of cash flow for the next 12 months, temporarily, because they used debt to pay their bills. So that means they would have cash flow increase, $750. 9,000 minus 380. We owe 8,620 times 1%. 86 to $100 is the monthly payment on that. Say it's $86. Where are we on cash flow? 860 minus 86. Now we're at 774 plus 750. So I decreased their cash flow, then I increased it by 750. So now we're at 774 plus 750. What do we got? 1,520. 524. Okay. So for the next 12 months on these two cards, we're just paying the minimum payments. For the next 21 months with Wells Fargo, we're just paying the minimum payment. And then, so far, look how many debt tools do we have? One debt tool, big bank card, two debt tools, credit union credit cards. Let's say they have a HELOC, right? Let's give them a HELOC. They owe $21,000 on the car. Let's say we move the rest of that $21,000 into the HELOC, right? And now my cash flow is $1,524 plus $700. So now I'm at $2,224 on 21K owed. If we just looked at 21K divided by 2,224, 21,000 divided by 2,224, that's 9.4 months. So in about 9 months or less, that's just making extra payments. Velocity Banking will speed that up. So we'll be able to bring the HELOC to zero before these two credit cards expire and long before the expenses, before the interest expires on this card, right? We're still paying the 140, still paying the 86. I've got 2,224 temporarily cash flow. It'll go down after 12 months. I got a 3-month gap. In that 3-month gap of 2,224, you know what I could do? The car's paid off, right? Boom. It got paid off first month. But we did it strategically. We leveraged 2 credit cards. We leveraged a credit card to run bills. And we leveraged our main debt tool, our HELOC or PLOC. So that's 4 debt tools total, right? To remove this car in the most efficient manner. I don't know. I have not seen the Money Max account software tell me how to do this. That's where I think the conversation of whether, that's the right product for you or not, if you're willing to do this kind of work, you still have to tell it what to do, right? Even when you click a button, it's going to suggest things, right? But it's not going to be as intricate as something to this effect, right? And that's why sometimes when I've ran scenarios, Velocity Banking looks worse in the Money Max account than if you just use a checking and savings. And I'm like, well, they didn't factor in what I'm doing here. It didn't tell me to go get 2 credit cards from a credit union. It didn't tell me to go get a credit card from a big bank. It's not telling me to go do these things, right? So I think that's where, if there's a world where we can combine Money Max account and coaching, which is something that I'm going to announce here, which I'm planning on doing for my community, and really anyone that has a Money Max account, whether you bought it from me, Christy Van, whomever, right? If you own the Money Max account, I'm establishing a community where we gather together. We'll all have our Money Max accounts open, and we'll go one by one. This is totally like me just giving, right? I just want to be of service, help those that spent thousands of dollars on their software and it's not really being used at its full potential. I want to help you get better. I think that's going to improve the reputation of the company. It's going to help with misrepresentation in the marketplace. Ultimately, it helps more people win. I want to see more people win in their finances. I don't have to get paid on every single thing that I do, right? I'll ask for support, right? You can give however you like into my ministry and what I'm doing here on this channel. You can support that. But that's what I'm going to plan on doing, is create a community where we just gather together and we go through these case studies with your Money Max account and inject coaching into your software so that you get the best of both worlds to improve the actual timeline, right? That's where I'm coming from. And I think that's how this could, really all come into play here. So the car got paid off, right? Sitting in the HELOC within 9 months or less. HELOC goes to zero, you would stop doing velocity banking. The Money Max account doesn't tell you when to stop doing velocity banking, which is why it also does not produce the best numbers sometimes. That's another thing that I talk about, right? Is I tell folks, hey, there's a world where we turn off velocity banking, then turn it back on. This is a perfect example of turning off velocity banking right around month 8 or 9. When the HELOC goes to zero, right? We don't need to borrow. So all we need to do is simply make extra payments to the 2 credit cards over here, whatever the balance is. So 140 times, say, 9 months is 1,260 divided by 2, so 630. So 7,000 minus 630 is 6,370. So 6,370 on both cards, right? I can simply make extra payments of 2,224 to 1 card at a time, let's say. Over the next 4 months, 2,224 times 12. 2,224 times 4, sorry. 8,896. So I could have 1 card paid off by the expiration date. The remaining balance of the other card, whatever it is, stick it in the HELOC. Do velocity banking. You've got a 21-month gap over here, right? This will be down $86 times 12 months, 1,032. 8620 minus 1,032. So you'll owe 7,588 on that card. Month 12, let's say. The bills will be due again. Let's say you ran another 9 on there, right? Or you did less. Let's not do that. You only did it once, right? Being conservative here. So you owe 7,588. It's been 12 months. You have a 21-month gap. You just keep paying the monthly minimum payment on that card. Don't run the bills again. Pay the bills directly from, let's say, another credit card, say the card that we paid off. We can transfer, say, okay, I'm just going to run my monthly bills through this card, right? So that means my cash flow goes down, right? 750 after, say, month 12. 2,224 minus 750. So now my cash flow goes back down, 1,474, right? And then let me just make sure. So yeah, because I'm still making, this monthly payment went away, so I have to get the 70 back. Yeah, there we go. I think that's correct. And you would simply continue doing velocity banking on this HELOC. That goes to zero. So now both cards got eliminated. We're still within the 21-month gap. We go back to just running bills on a credit card, paying it off in full, running bills on a credit card, paying off in full, pay no interest. No interest here, no interest here, no interest got paid, totally offset. You'll be left with this balance, wherever that is, at month 21. You stick it right back in the HELOC, do that. Or we can rinse, lather, repeat. You go and acquire another big bank credit card, or you go to another credit union, get a credit card, and you do it again, right? Like, this is where the complexity comes into place, accountability. Where people mess themselves up is they try to go get 5 of these, 3 of those, 2 of these, right? And they end up with 15 cards. They don't know what to do with it, right? But if we just picked one, have our main debt tool, there can be a nice, healthy flow here to eliminate certain debts, okay? So I'm going to leave that there for a second, but just know that all this is being recorded. So you can go back, watch this in bites, and then I'm going to fix it up with breaking up the content so that you can watch it again. Okay? So let me see what's going on in the comments. Let's see. Betty says, thank you for answering my question. You're welcome. Dan says, definitely set up a call for case study. Helped us. Yes. Yeah, I'm so happy to be working with you. Does the Money Max account only sell IUL? From what I understand, yes. Okay, so I have some requests over here on the left-hand side of the board. And the reason why I put these requests out is because I put out a video a couple of years ago doing a review on United Financial Freedom. And I have to say, I think they heard me, because they ended up doing things this year around March. They updated the Money Max account software. They added some things in there where I was like, oh, wow, thank you for that. So for example, they added 0% introductory credit cards. Prior to March 2024 and back, you could not add a 0% credit card and the software would know what to do with it. So of course, Velocity Banking is not going to look as clean on Money Max account, because you couldn't introduce a 0% credit card to push the balance over here, and then like the Money Max account is not going to know where to pull from, and it gets a little confused. They finally added that in there. That's a major help. Okay, so let me give credit where credit's due. I think they're listening. Okay, so I'm gonna create another little short clip video here for United Financial Freedom. And here are my additional requests. Okay, they really need to update recommended banks and steps for the client to go and get the right debt tool to do Velocity Banking. Again, Money Max account as of right now is not teaching how to go and find the right debt tool to do Velocity Banking. And when you guys get the wrong debt tool and try to put it in the system, then the system is like, hey, it's better just doing a checking and savings. Velocity Banking will take longer, right? And you're trusting the software, not realizing that you didn't give it all the information that it needed. Okay, so I'm going to show you guys what they give you in terms of it's like a little PDF, how to find a HELOC. I'm like, oh my God, you guys make multiple millions of dollars, billions of dollars. Like, help me out here, bro. Right? Help me out. Okay. Again, I've got a whole playlist titled All About the Line of Credit. Literally gives you the blueprint for free, DIY style, to find you the best debt tool to incorporate this strategy. When you have better debt tools, your numbers will look better. It's going to be that much easier. Okay, so let me just find it real quick before I share my screen. Where is it? Let's do, well, to answer that one question from before about the whole IUL thing, I'll show you this, that right over here, all they have is an MMA Pro / IUL, right? MMA Pro / IUL FAQ. They don't have a whole life one, which blows my mind, because I'm like, you guys are using a risk product to educate your audience on how to eliminate debt faster. That's, excuse my language, that's ass backwards, right? So by using a whole life in conjunction with the Money Max account, you can actually guarantee the client things, right? You can actually have a steady flow as to what the dividends and the guarantees are, and we're not going off of what we think will be the case, because that's what you're doing with an IUL. You're thinking, okay? You get an IUL, they can change the cap rates, they can change costs and fees. It changes, right? How is a software supposed to know that? So you have to update it every single year when the cap rate changes. If it thinks it's getting a cap rate of this and a guarantee of this and the fees are this, it's not the same, right? So that's going to be a problem for them. You know, I really hope they improve on that. I really do. I would hate to see another lawsuit happen with this company, right? I would hate to see that. I would hate to see more problems. So let me try to find you their, let's do client resource. Okay, so they call it an HELOC, an advanced line of credit. Okay, show you this. This is what they call it. Characteristics of an advanced line of credit for the Money Max account program. Must be open-ended, must be in a draw period. The longer the draw period, the better. Example, 5-year, 10-year, 15, right? Lowest dollar amount minimum per paycheck written for HELOC. No fee per paycheck written. No limit to number of checks. Cool. For best functionality for online banking, ability to transfer money from checking to HELOC, HELOC to checking. Cool. No limit to number of funds transferred per month. Cool. No fees. No dollar amount limit on funds transaction. Right? I agree with all what they're saying so far. Right? Then they have questions, all this stuff. Cool, cool, cool. Here's who they recommend. Are you kidding me? Wells Fargo. Bank of America. Come on. I've been doing this way too long. This should not be your standard recommended banks. Oh my goodness. There are so many better credit unions out there in the United States, in your local state, in your local county, in your local city, where you get much better interest rates, much better deals. That's a joke. Okay? So hopefully, Money Max account, I'm calling y'all out, please update that crap. Right? I've been doing this way too long. I'm too young. Y'all know this. Y'all been in the business much longer than me. And it took me 2 seconds to figure out, okay, big banks have more fees, more charges, more closing costs. So you were correct the whole thing up. Try to avoid fees. Try to avoid closing costs. You go to these bigger banks, they're going to have closing costs. You go to the smaller banks, they waive it. They give you an intro rate offer, right? The standard interest rate tends to be 1%, 1.5% below prime. If you're dealing with military folks, you educate the military. Go look for military-based credit unions, right? That may even give an additional discount for being a veteran. Are you a police officer? Are you a firefighter? There's literally credit unions dedicated for police officers and firefighters in certain areas of the United States where they give a better interest rate. Okay, that's going to be a little short clip from my editor. Send that, make it click worthy so that it gets picked up by Money Max people, and then it goes to the higher ups and like, you know what, let's do this. Let's make it better for people. We should not be sending people to TD freaking Bank, like Citizens Bank. Like, get out of here. Bank of America, no. Wells Fargo, no. Get out of here. Go with the smaller banks. You're gonna get a much better deal, right? And then even as it relates to the difference between a first lien and a second lien HELOC, I'm still not seeing that education there, and people get all messed up, right? So you've got good first lien HELOC options out there as well that will save you money. I mean, there's so much, guys, that I think United Financial Freedom Money Max account can really improve on. So that's going to be my recommendation there. Okay, so please update that. Also, you guys need to add the savings account transfer / transaction limits. Okay, if I don't understand I don't know how they're calculating that, but when you send money from your checking to your savings, right, and you move money out of your savings via a transaction or a transfer, there's usually limits. Banks usually have like limits. You can only transfer 10 times a month, 6 times a month, or something like that, and then you get charged a fee. So the Money Max account needs to be accounting for that, right? So create a little button so that the client knows that if they're at a bank that has a transaction or transfer limit on their savings account, that they can factor in the fee if they go past it, right? So that's very, very important, right? Y'all can update that. And what I'm gonna do, just to kind of lead as an example here, being in the company, is I'm gonna provide longer coaching terms or maybe like an add-on service. I haven't decided yet. I'm going to start off just giving, but I want to do longer coaching terms for those who buy the Money Max account, because there is a drop off in performance, right? That, you know, people start off great and eventually they drop off once the coaching stops. You know, I've had the Money Max account for years. I don't have anyone hitting me up, right? Letting me know, hey, how you doing? Right? No one's hitting me up. So if you've had the Money Max account for years and the original person that sold you it is no longer available because now they're a director in the company and they're too good to, you know, talk to their clients, that can happen in the MLM network marketing world. That ends up happening is you get someone that sold you the Money Max account and now they're in Hawaii, they're over here, you can't reach them, they've retired, they work 4 hours a week, right? You never get a hold of them. It's like you're trying to get service and they just kind of pass you off to the staff team, and that's kind of like talking to a bank. There's a big difference between support and coaching, accountability. There's a big difference, right? So I think there's a lot that could be done there as an add-on service or some kind of add-on service for people who have bought the Money Max account, and they can tune in to a Zoom meeting, a webinar on a weekly, a bi-weekly basis, and however many people want to, you know, serve at that capacity to help these people stay on track with their finances. Because at the end of the day, the software is just a software. It's telling you what to do. But what happens when you don't do it on the day it told you to do it? And then you don't do one thing, and then you don't do another thing, and then you don't do another thing, and then you fall back into your old ways, and then you mess up, and there's not that additional support there. So that could be a problem. So I want to be able to solve that problem. Okay? I want to be able to solve that problem. And then finally, y'all should consider whole life over IUL, or at least introduce whole life. If you're going to tell people to buy a $5,000 plus software, and it's going to show them to get out of debt, and you're going to guarantee that debt-free date, and then that client gets sold into buying an IUL in the hopes that they'll somehow have more money when this is all said and done, you cannot guarantee that. Y'all will get sued. That was not grammatically correct. You will get sued. Company's already gone through problems in the past. I would hate for this company to fall into this trap, the IUL trap, of misrepresentation of the IUL product. A great person to go check out is Chris Kirkpatrick, who has been dedicating his whole life to teaching folks how to properly use the IUL product and how it is missold, misrepresented, right, in the marketplace. And a lot of people are going to get hurt, especially my seniors and my baby boomers. Y'all are going down a path. You're funding these IULs. You're not paying attention to the cap rates. You're not paying attention to the internal costs each and every year rising inside of your policy. You don't know how to track the internal rate of return. Your agent probably doesn't know how to do it. And on top of that, was it even designed correctly? So it's like we're talking about so many other factors beyond just getting out of debt, right? That's like, this is important, okay? So if we consider whole life, at least it removes all the risk factors, right? With a properly designed whole life, you have a set guarantee, you have a pretty steady non-dividend rate, you understand how to properly borrow from it, right? And you got to get the right people in the community that have dedicated their whole lives as life insurance agents to come in and teach the salespeople, because the salespeople they're just pitching the next product. So it's like a product on top of a product, right? Like Diane has the Money Max account, right? Who's here with us. So Diane buys the Money Max account, and then her salesperson says, okay, now that you got rid of this and this, okay, let's go look at an IUL. And she's like, well, what's an IUL? How's it? Well, it's a great way to, send your money through here, borrow it out, blah, 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 pay off your debt faster, or it's going to increase your debt-free timeline, but you're going to have more money at the end. And it's like, you can't guarantee Diane that, right? So it takes away from the mission of guaranteeing people that they'll be debt-free at a specific date and time. And when companies get away from their mission, you see them turn and burn. It's not good. So I'm just trying to, provide you guys that transparency, that honesty, and say, look, please pay attention to these things. You got to look at the numbers. And hopefully the United Financial Freedom team company would take this, because I actually like the company. I'm on the same team. I want to see them win. I want to see more people helped, right? And I think this is the way we go about doing it. Possible game changer to gain points for rent/mortgage is this card called Built. 1% back on those payments with no fee. Have you heard of it? I have not heard of Built, Murillo. I could look that up. Denzel, you're correct about the bill matching. Bill matching sleeper cards are designed to stop the bleeding. However, your main credit card is being paid done with the extra account. Eventually, you get to the bill matching cards as being the main credit card and paying those down. Yes. Absolutely. Citi has most of their main credit card products with 0% interest for 15 to 21 months. Yep. Paulie, how do you figure cost of daily rate of interest on a credit card, and what's different between monthly, yearly, and or daily compounding? Okay, so let's discuss that. So calculating the interest costs on a credit card can sometimes be a little tricky, all right? I'll do my best to explain it best I can. Okay, let's do this. Boom. Let's do this. All right, so what we're gonna do first, I'll give you the Google's definition, how to calculate credit card interest. This is from Chase Bank. All right, so let me share my screen real quick. I'll give you the formula so we don't have to guess. How do I calculate my monthly APR? Divide your current APR by 12 to find your monthly periodic rate. Multiply that number with the amount of your current balance. For example, if you currently owe $500 on your credit card throughout the month, current APR is 17.99%, you can calculate your monthly interest rate by dividing the 17.99% by 12, which is approximately 1.49% each month. Okay? Then multiply 500 times 0.0149 for an amount of $7.45 each month. Therefore, you should have been charged $7.45 in interest charges for that month based on your $500 balance. Right? And if we scroll, I think how do I calculate my daily APR? Right? So you just take that rate, divide by 365, and that should give us roughly how much we'd be paying in interest per day. The only thing that affects that math, right, is when you pay the credit card. So interest is charged on the due date. Okay? Interest is charged on the due date. What affects what you actually end up paying in interest is based on the statement balance. So a hack from earlier, what I was talking about with credit cards, a hack that we can implement is, let's say the due date on your credit card is the 1st of the month, and your statement date is the 4th, right, of the month. Ideally, you should pay all bills after the 4th and between the 31st of every month. That should be your range. After the 4th, so the 5th to the last of every month. So you don't ever want to run bills on your card between the 1st and the 4th. When you do this, you are manipulating what you actually get charged on interest on the due date. In fact, if you ran bills between the 5th and the last of the month, you won't even owe anything on next month's due date. It won't have a payment because the statement cycle closed. So you get like an additional 20 plus days. Once you get to that cycle and it registers, then it'll say, all right, we're charging you interest on the $1,500 that you owe on this card for that time frame that you owed it for. It's imperative that you pay this $1,500 on the due date or before. If you pay it before, right, you are effectively going to reduce the amount of interest that you would pay. So let's do an example. Let's say on the 5th, you run $1,000, and the 10th, you run $500. Well, let's say we're at 17.99%. 1,000 times 17.99% divided by 365. 0.49 cents per day for 5 days. So far, I would have built up $2.46. Then the 10th, I run up $500. So now I owe $500 between the 10th and let's say the 30th. Okay? This is 20 days. Okay, so 1,500 times 17.99% divided by 365 is 73 cents a day times 20 days. 14.78 plus $2.46. You're at 17.24. Now, in this example, let's say you did my strategy where you set your bills up between the 5th and the last of every month, because your due date's on the 1st and your closing date is on the 4th. The closing date is when the statement cycle ends, and then you're sent a statement in the mail. It says, here's how much you owe us. In this example, if I'm in June, I will not owe anything on July 1st. Okay? Not going to owe anything on July 1st. So let's say July 1st through the 4th, owe what? $1,500. So 1,500 times 17.99% divided by 365. 73 cents times 4 more days. So we're at $2.95 more accrued on top of the 17.24 that has accrued. Now, here's what's going to happen. When's our next due date? July, August 1st is our next due date. So from the 4th to the 31st, so that's how many days? 31 minus 4, 27 days, right? So between the 5th and the 31st, we're going to run another 1,500 on the card. You'll start accruing interest, but I'm not going to account for that just yet, because the statement balance says for August 1st, after July 4th, our statement balance is $1,500, right? And it is imperative that we pay at least that on August 4th, because if you don't, you're going to get hit with interest for the month of June and July. So we got 17.24, 295, 27 times 0.73, another $19, 71 cents plus 295 plus 17.24. So we got $39.90 if we don't pay the 15 in full. Let's say you were running short on this 15. You didn't have the 15 to pay it. The next best thing we can do is pay as much as we can before August 1st, because it's going to reduce this amount of interest, because it's daily, right? And the compounding part occurs after every cycle, right? So let's say that the minimum payment is $50 on this card. Right? Say the minimum payment's $50. You've accrued $39.90 in interest. So that would mean only $10 reduce the principal, $14.90. We have to add $39.90. So $14.90 plus $39.90. And this, Paulie, Reacher, is where you get daily compounding rate. So a credit card is a simple interest credit card that gets charged daily, and it compounds every single month. So now, let's say all you did was pay the monthly minimum payment that month. This is where people truly get into a lot of problems with their credit cards. Is that daily compounding per month starts to feel like it's, I don't know, it's like more than 17.99, like technically, because it's on a bigger balance now. So it's still 17.99, but it's on a bigger balance, right? Because now we owe 15,2999 times 17.99% divided by 365 times 31 days. So that'll be another $23.37 on top of 15,2999. Say you pay 50 again, right? 50 minus 23.37, balance principal $26.63 went to it. So 15,2999 minus 26.63, 1503 plus the, I think I already accounted for it, something like that. So it's gonna take forever to pay this off when we do minimum payments. But now, this is where the concept of running a bill to cover your monthly minimum payment to essentially kind of create cash flow, to buy time, to reduce the hit. This is where, if you want to reduce that hit, right? Let's say we're dealing with someone that doesn't have cash flow. They went into debt, right? They're bleeding in their finances right now. They lost their job, whatever it is. They still have bills. Bills need to be paid, okay? If they have $1,000 worth of expenses that we can run on the card and get some cashback rewards, 1-2%, let's just say. So anywhere from 10 to 20 bucks. The payment on this minimum is $50. They have $1,000 worth of expenses. If they were to dump the 1,000 into the card, it's going to manipulate and affect the daily interest cost. They're still going to have to swipe the card $1,000, but now what happens is 100% of that $50 went to principal before the due date. So that's actually going to lower the balance. And then because they ran $1,000 and they got $10 to $20 in cashback rewards, they apply that. Now it's $70 to the actual principal in an example here where there's zero cash flow to work with. So in a way, when doing this, you can reduce the credit card balance faster, right? Much faster than just making what? An extra payment, right? With me? Did I lose you? Let me know. Good stuff? It's a lot. I told you this is going to be deep. We're 2 hours in. 44 people watching. I told you it's going to be deep. I have the Money Max system because I'm not able to get a HELOC or PLOC. It helps me pay off everything, including my mortgage, in less than 6 years. Simple. Simple. Here's another thing. Again, but velocity banking may not, again, be the route for everyone. And I know there's others that say velocity banking for everyone and all this stuff. And I'm like, I'm just not going to play that game, right? I don't think that's the case. Dan says, best of both worlds. Absolutely agree. I would like to speak with you on the Money Max account. How can I reach out? John says, I will never use a big bank again. Thank you very much. I just started Money Max account 2 months ago, recommended by Christy Van. Awesome, right? So yeah, so there's a world where you buy the Money Max account and you just do your checking and savings sweep function. And I think what we can do little by little, especially with credit cards, that's going to add a little more velocity to your debt elimination. And when you compare someone that's doing debt snowball hand and paper, right? Pen and paper, I said hand and paper. When you see someone doing debt snowball pen and paper with their own Excel, let's just say, what they're forgetting to calculate is when are they making the extra payment. Typically, most people make their extra payment toward debt at the end of the month or once they've evaluated their finances and they see how much cash flow is left over. That is very inefficient. What Money Max account says is like, okay, on the 7th, pay this much. On the 13th, pay this much. On the 21st, pay this much. Every time you get income coming in and it knows your expenses and it knows the due dates of all your expenses, it's literally telling you the best time to make a payment toward that specific debt, which is basically the sooner the better. That's the template there. It's getting you to make your extra payments faster than that snowball or that avalanche. And then it's running the calculations on the back end to say, yeah, target this first, then this, then that. And I believe when I've gone through the Money Max account, I think it's not just factoring in smallest debt to highest debt or highest interest to lowest interest. I think it's factoring in a lot of different scenarios to basically compare. So it'll do maybe a debt snowball, smallest debt to highest, avalanche, highest interest, lowest interest, cash flow index. Cash flow index is focusing on cash flow, right? I think they've incorporated those algorithm methods, right, which spits out a result much quicker, right? It says this is the fastest way, and we guarantee it, right? I recently came to know that your brokerage account could be used as checking account and also gives 5% interest on any money lying down there, so no need to make a transfer from checking to savings. Yes, so especially in the environment today, Amit, another thing with the Money Max account is the whole concept of checking and savings sweep. Sometimes that doesn't make sense, because what if in this case you could have a checking account that also is earning an interest rate on it while the money is parked and you're not doing no velocity? Why do I need to move money out to then make the extra payment, right? Why can't I just have, say, just the one account and then it just tells me, okay, here are your bills. When the checks come in, it's having money set aside to pay those bills, and you're going to make an extra payment of this and then an extra payment. So what's happening is you're making multiple extra payments in the Money Max account software throughout the month based on how you get paid. The faster you send your principal dollars to the debt, the faster it'll get paid off. That's what Velocity Banking does, right? So the software is doing it with just a checking and a savings account, right? But there are some cases where, like, I don't really need a savings account. Hi, Denzel, do you have recommendations for banks or credit unions that are better for Velocity Banking or the best way to search for them? Yes, Murray. I have a playlist called All About the Line of Credit, and that will change your life for the better. Let me share my screen, and I'm going to drop the link in the chat. Let me get that done for you real quick. So let's share my screen real quick. All right, share screen. Playlist. All About the Line of Credit. Boom. I'm about to drop that in the chat. That is the DIY playlist of playlists. You cannot go wrong. I cover everything, right? I cover it all. Money Max account is for life. Yes, it is. For how long you have Money Max? I think I'm going backwards on the comments. For those out of debt or close to being debt-free, look into credit unions that allow double dipping. Explain more. You mentioned switching monthly to annual when you use your credit card to run your bills. Can you explain the switching to annual? Yeah, absolutely. So let's revisit that real quick. So I'll kind of touch on the general bills. You have, at most subscriptions provide an incentive to pay annual. Car insurance, maybe a phone bill, maybe. Who else? I'm trying to think. On the business side, most software products for your business that have subscriptions, all right, all let you save money. This is usually the range. You save anywhere from 10 to 20% on the bill itself. Or if there's any type of expense where you can get a deal, or if you pay in full, they give a discount, that's what we're looking for. Sometimes when people go shopping, your Costco, your BJ's, when you pay in bulk, what do you get? Discounts, right? So you're paying for stuff for the whole year, say toothpaste, toilet paper, right? If you buy that kind of stuff in full for the whole year, right, non-perishables, you run that through a card because the card gives you the capital to pay for those things in full. And if the card is on 0%, Sylvia, right, this gives you the time to pay it back at 0%. So A, you're saving money on the bill by switching from monthly to annual. When you do that, you instantly create more cash flow. Cash flow, gain, temporary, right? Then it sits on the card and you pay the monthly payment until 0% expires. Let me know if that was more helpful, Sylvia, if that was clear, right? So there's multiple components. You're getting an incentive to save money on the bill itself when you switch from monthly to annual. You ran it on the card, 0% preferably, and you got cashback rewards, so you saved even more money. You use those cashback rewards to apply toward the balance of the bill, which reduces your cost of living even further. And sometimes you get a statement credit if it's a new card. So statement credit for, spending a certain amount. Get anywhere from like $100 to $700. Capital One Business has one where they gave me $700 if I spent a certain amount of dollars on business expenses. So I ran a bunch of business expenses through that card. I got $700 back. So I reduced my business expense by $700 and I got points, applied it to the balance, saved even more money, right? So all this does is just increases efficiency. Let me know if that was clear or if I still lost you. Let me know. Paulie says, sweet, exactly what I need clarity on. You rock. Thank you. Is it possible for you then, please create your own software that includes Money Max features plus line of credit plus whole life and then combine it with your own coaching? I think that is possible. I think it is. In the meantime, I'm just going to use what's available in the marketplace. I'm not that smart to invest in putting what I know here into a software, but I do have relationships with people that want to do that. Shout out to the Kwok brothers. The Kwok brothers are putting together a software of their own to incorporate this strategy. So we're going to see more competition as velocity banking gets more and more attention. That's another thing I want to share with you all, that velocity banking is going to become mainstream probably in the next decade, thanks to the multitude of content creators that are bringing this to light, and as well as banks also backing up the concept. All-in-one loan, First Savings Bank, University Bank are three banks that are in favor of using HELOCs to create wealth, create cash flow, leverage, pay off debt, accelerate debts, do those different things. So we're having the support of banks now, and more will come. The support of more credible content creators, business owners coming together, educating, coaching, companies like United Financial Freedom. There's the other company, Pill Method, right? The Kwok brothers are going to have a software coming out. And then I have a relationship with someone that is also trying to put together a software that incorporates the mathematical equations of getting out of debt, the different scenarios, where it can just kind of spit out the different scenarios. What I would love to see Money Max Account do is show the formulas, right? I mean, I already know them because it's like, I give it to you right here. But it'd be pretty cool if it showed, here's what debt snowball looks like. Here's what debt avalanche looks like. Here's what cash flow index looks like. Guys, like, that's it. There's no other crazy magical math that's going on in behind the scenes on the software. That's it. That's all you have. Someone makes money, they have bills, they have cash flow left over. The software tells you how soon to make those payments with that cash flow in an efficient manner. And the system will target either interest reduction, cash flow focus, or smallest balance to lowest to biggest balance. And I think it kind of merges all three, and it just compares and says this one's the fastest, right? I think that's what it's doing. Okay, great, Sylvia. So thank you for the explanation. Glad that helped. Okay, we touched on velocity banking. We touched on credit cards a lot. We touched on Money Max Account a lot. Infinite banking was the last thing that I wanted to touch on, and I kind of briefly went over it because I know that in the United Financial Freedom world, I think they're also using the term infinite banking, but the product is IUL, right? So if we're gonna go back to original facts of history, where this stuff essentially comes from, right? We have to be able to go back to history and see where do these things come from, how they sprout out, and why do people believe these certain things. Okay, so the people at UFF running UFF are not originally life insurance agents. They did not come up with the infinite banking concept. They did not do the time that many of these other guys have spent as it relates to infinite banking. So UFF is predominantly main focus a debt elimination company that is trying to get in the life insurance space with IUL. Now again, for these guys being so smart, putting these calculations together, it blows my mind that they got sold this. They got sold into whatever math they read or saw on IUL. Instead of, go back to the root. Before IUL was even a thing, right? You have to understand, IUL started in 1996. That's when Denzel was born. Are you kidding me? There's no history. Little history. You look at the most successful people in the world, man. They have whole life over IUL. The most successful people in the world. They have whole life over IUL. And if they do have IUL, they're not using it the way the content creators and TikTokers are teaching it. That's another problem. I'm actually not against IUL as a product. I'm actually not against it. I'm against how it's sold and how it's misrepresented. And if you look at the history of IUL, there's been so many lawsuits, so many variations of the companies changing the product because they violate different things. Right? That is not a good track record. That hurts the reputation of UFF. That hurts. Right? They have to deal with that. So, founder of Infinite Banking concept, Nelson Nash. Okay? He essentially brought it to light. All right. He has a way of designing the concept using whole life insurance. Not just any whole life insurance, but a mutual owned company, mutual insurance company, dividend participating whole life insurance. And then there's a specific design that goes into this, right? And then with that, the concept of using a life insurance policy to pay off debt is a whole nother mathematical equation that I know the software is not getting correct. Because in an IUL, you're adding these other factors that whole life simply doesn't have. Whole life is simple as this. There's a base premium, there's a PUA, and there's a term. That's it. That's your cost. IUL has a steady base premium, has a PUA, there's a term, it's a increasing term, right? And you have fees, okay? There's admin fees, there's temporary fees that fall off. So like after 10 years, that fee will go away. This fee stays there. You've got annual fees, performance fees. There's a lot. This is not steady. That's not steady. This is not steady. And then you have to change the product as the client gets older. I know the company does not have qualified people at scale to be providing this product. It just ends up being like a standard sort of like throw it together. How much money you got? Okay, $1,000 a month, $500 a month. Like you're not going to do much with little dollars, right? And especially when you're funding it on a monthly basis, it costs even more money, but they don't tell you that. When you fund it annually, there's an incentive. It's cheaper. It's going to function better, right? So there's just a lot that it becomes, unfortunately, very frustrating. So I'm like, wow, what a great company to get, down in this world with the IUL. And it does not have a great track record, all right? I mean, let's look at a real policy. Like I would ask anyone that has an IUL that apparently designed it for infinite banking If you had it for multiple years, like, show me how you designed it. I want to know if you did any 1035 exchanges to, get the next thing. What multipliers are in there. Do they get removed? Do they fall off? How active do you have to manage this IUL? And that's a big part too. With an IUL, it's an actively managed account. You have to be active on it. It's not a sit and forget, not a set and forget. You need to actively manage the performance of your IUL. With a whole life, you do not have to actively manage your whole life. You just simply fund it. And it does what it'll do, right? To me, that's a little bit cleaner if we're talking to majority of Americans that are still trying to be better stewards over their money, and you're going to give them a software and a life insurance policy. And remember, you still have to manually request the loan. It's got to get to your bank account a certain day. Does the software account for those days that you're paying interest when you borrow and the time it hits your account, and then you're supposed to make the payment? That's a lot. That's a lot. That's all I'm saying. All right. So that was a touch on infinite banking as it relates to Money Max, of kind of like what's going on there. And I hope in time that things could be considered, even if they keep the IUL fine, but to have no action, no presence with whole life is an absolute disservice to the users, right? Because they're just being told that IUL will perform better than a whole life. On paper, that is absolutely true. I'm not even going to lie to you. Like, an IUL illustration will always outperform a whole life all day. But has it actually done that, and how many times? Like, I'm finding it uncommon. It's rare to find people that have an IUL. I'm talking about the customer, not the guru, right? The customer that buys an IUL. I find it extremely hard to find someone that has an IUL, owned it for many years, say a decade or longer, and we look at the original illustration and it is not matching what it's actually performed like over the years, looking at the actual numbers versus what it was projected to do. Whereas a whole life, even a poorly designed whole life with the wrong type of company, will perform neck and neck with the illustration provided. That's what's amazing, right? So even a poorly designed whole life will perform. Like, I have people that have like a whole life with like Globe life insurance, Gerber, and they've been paying into it since they were a little kid, or their parents paid into it, and it's got $20,000+ of cash value in there. It's guaranteed. It's steady. It keeps growing. Yeah, growing slow, but there's guarantees, right? And then you properly design a whole life. Oh my goodness, right? You're able to get that consistency in your numbers and be able to make these proper projections. So yeah, Jay says, good stuff, good stuff. Awesome. Are there any other questions before we close out here? It's a 2.5-hour masterclass. We went deep. Those of you that, let me give you the process with the Money Max account too, like how it's sold. And by the way, don't ever pay anyone, right? It's free, right? So the Money Max account, the way you buy it is you have to be given a demo, right? So you submit your numbers. So you could send all your numbers to me. I have the authority to sell the Money Max account, so I can help you. I can do the demo with you, right? You submit your numbers. I put the numbers in the demo, and then the demo spits out a result, right? We go over that result together. It's like an analysis. Gives you a debt-free date, right? And then you get a quote, right? And from what I've seen, the typical range is somewhere around this number. If you're military, there's a 10% discount. So at 5K, you end up paying like $4,500. That's no secret. That's standard for everyone. That's not a selling point. That's just standard, right? It doesn't cost any money to do a demo. That's another selling point. They're like, and, the gurus are like, and you can, see how this will work for you and get your analysis done for free. If you sign up with me, it'll be free. It's like, dude, that's a standard. It's free. There's no fee for that, right? So I'm just letting you know, I'm giving you the truth. That's free. That's free. That's standard. Okay. Once you decide to buy the software, then there's it's lifetime access. And what I've seen over the years is the Money Max account does update, right, over time. So that'll create more, benefits for you in the long run, right? So lifetime access and limited coaching. Right? But with me, what I'm going to be implementing is group coaching for anyone. So even if you didn't buy the Money Max account from me, right? I would like to serve you if you're struggling with the Money Max account. If you're good, great, right? But there are a lot of people struggling with the Money Max account and they don't feel like they have support. And they spend all this money and then they hire me. So I'm like, dang, I'm sorry. You paid all that and now you got to pay me. And so I'm like, you know what?